Hello and welcome to a new Virtual Investment Summit by Fund Society. Bienvenidos a todos los que nos están escuchando desde Latinoamérica en el día de hoy. Today we're going to talk about currencies and about how to hedge the currency risks in your portfolios. And we're going to do so with the help of three experts from DWS. I'm going to introduce our host, Ayviel Sanchez. Ayviel is a Senior Relationship Manager for Latin American coverage at DWS, and he has nearly 2 decades of experience in the financial markets, having joined DWS in 2018. Hello, Ayviel. It's nice to see you again.
Thank you. Buen día. Good morning, Alicia. Good morning to everyone in the Americas. As Alicia mentioned, my name is Ayviel Sanchez. I'm part of the Latin American client coverage team, and we wanted to welcome you here today to the Fund Society Investment Summit around methods of managing currencies. For those of you who are not familiar with DWS, DWS is what used to be Deutsche Asset Management until 2018. We're almost a $1 trillion asset manager based out of Germany with capabilities in active, passive, and alternatives. As you can see, we have decades of experience managing in those three buckets, but relevant for today's conversation, our passive franchise has a legacy of more than 20 years under the Xtrackers brand. Many of you might remember the DD Trackers brand, which turned into Xtrackers brand. Currently, Xtrackers is the third largest ETP or ETF provider in Europe with UCITS. And for a long time, we were the second largest until recently when two of our competitors merged. Globally, we still have scale since we're the 8th largest. For today's webinar, we have two great speakers that will be discussing the methods of managing currencies in portfolios. Dean Allen, Senior Passive Specialist for U.S. Offshore. Many of you that are from the U.S. Offshore segment know Dean from his days in prior firms, but covering ETFs and passive and his experience. And also we have Jason Chen, a Senior Research Analyst from our thought leadership team. Jason, you might not have heard of him, but he's behind the cameras doing a lot of research and thought leadership content that is published through our website and sent to you via email. Between the two of them, they have decades of experience, of industry experience, and I'm confident that they'll make today's webinar very relevant for you and your business. Two housekeepings before we pass it on to Dean. The duration of today's presentation should be around 30 minutes. So you'll notice that Dean and Jason will go right into delivering the main points. And of course, you can always ask questions through the chat, but it's available at any point in time. So with that, let me turn it over to Dean. Dean, please go ahead.
Great. Thanks so much, Ayviel, and thank you, Alicia and Fund Society, for allowing us this opportunity to talk about this very interesting topic. Before we get into the content, I just thought we would do a little bit of level setting, Jason. So if you're ready, help us understand basically what causes currencies to strengthen or weaken relative to other currencies.
Yeah, thanks, Dean. So long-term, typically, currency trends are driven by valuations, so purchasing power parity, real effective interest rates. Those are the main drivers. But I think the main message that we want to get across here, and I think really this past year has indicated that, is timing currencies in the short term is extraordinarily difficult. And unless you have a very strong directional currency view, there are really compelling reasons as to not take that currency risk on. So not exactly an answer for your question over the short term, but frankly, it's quite a challenging market to time, and we've, this year has been a very strong case as to why that is true.
No, that makes a lot of sense. No, thank you for that. And one more thing that was on my mind that I thought the audience would like some clarity on. Over at least the past year, we've seen a lot of strength in the U.S. dollar. In some cases, up 10 or 15% against other major currencies globally, like the euro or the British pound. So how did that happen? Why are we seeing such U.S. dollar strength today?
Yeah, so I think you can broadly attribute the dollar strength to two main components. One being the fact that the dollar is a safe haven currency. In other words, when risk assets sell off, the dollar tends to be strong. So in periods of significant macroeconomic uncertainty, market uncertainty as well, the dollar is typically one of few assets that can behave in a relatively orderly fashion and, in fact, have positive returns relative to other currencies. The other driver is the divergence in interest rates, which is both a driver of spot return, but also a driver of currency carry, which is a big part of our framework as well to get into. But basically, because the US has been hiking interest rates more aggressively than basically any other developed market around the world, US interest rates are higher, and therefore people who are effectively lending dollars and borrowing other currencies are able to generate incremental interest above, in addition to what they would typically get from the returns of their portfolios.
That's great. I really love this topic around currency carry. We're going to get into that in a lot of detail coming up, and I find that to be probably one of the more interesting parts about this overview. So, Alicia, if you could move us forward to the next slide, and Jason, take us right into the content and tell us about currency hedging and the impact on the portfolio.
Yeah, sure. So to start, we go through some of the misconceptions. I think it's kind of important to frame a lot of the questions that I think a lot of investors have about currency hedging. And all of these should very much tie to the charts that we show later on, the evidence as to why currency hedging makes sense on a more strategic or structural basis. So the first one being currency hedging reduces the diversification benefit, i.e. the currency is a good diversifier. This is, I think, one of the main misconceptions. Typically, when we're taught portfolio theory, we're taught that anything added to a portfolio diversifies the risk. Because currencies, and I'll get into this a bit more on subsequent slides, but because when you own international equities and you don't hedge the currency, you basically own 100% of the equity and 100% of the currency. This is just no longer true. The second point is currency hedge relies on an active view. So this is kind of flipping it on its head, and it kind of ties into the next question as well. We always kind of assumed that owning the currency risk was the default. But if you think about it logically, owning an additional risk should never be the default unless you have a view on that specific risk. And parlaying that into the third question, which is currency hedging is expensive, there are two kind of angles to answering this question. One being, is this an easy market to access? I think with the growth of the ETF business that provides cheap beta to currency hedge markets, from a trading standpoint, this is no longer difficult. And then from a carry standpoint as well, because the dollar interest rates are higher than, let's say, European interest rates, you were actually able to generate currency carry by buying forwards at a discount. The fourth point, which is a little bit tangent, but I think nonetheless relevant, is that currency risk does exist in ADRs. Typically, when people buy international investments, they don't think they have currency risk. In fact, unless the ETF or ADR is explicitly currency hedged, you are going to assume currency risk that you may or may not want. That's ultimately a decision that investors make, but I think one that they should be aware of when they make that decision. And then the last component, or the last misconception, I would say, is that currency risk is an inherent component of international equity investing. Again, this is kind of an aggregation of a couple of the previous points. But really, the point that we're trying to make is currency risk is not something you assume that you have to take. It's something that you take in a thoughtful manner if you have that strong view. And again, I would say I used to manage portfolios before my research role, and timing or predicting the directionality of currencies is just one of the toughest things that that investors are asked to do. So in my view, why do that when you have other sources of investment return that you are more confident in?
Great. Alicia, let's move forward. Jason has a really nice 3-part framework for looking at currency risk.
Yeah, so this is actually quite simple. Really, it's when you evaluate any sort of investment, you measure risk and return. So risk, in this case, we show as volatility. We can demonstrate that historically, hedging the currency risk reduces your volatility by 1.5 to 2%. This translates directly into the magnitude of the drawdowns when things don't go the way that you want them to go. And the return is driven by 2 components. One being the currency carry. In environments where interest rates are different across different regions, there is the ability to generate either positive or negative carry. At the moment, it is very strongly positive, but I would just caveat that by saying it's not always the case, but it is currently the case. And then the spot return, which, as I mentioned before, when you asked the question of predicting currencies over the short term, we have our forecast for currencies, but in general, that is an extremely difficult thing to do. And so it's really dividing this framework into what we know and what we don't know. We know the volatility and for what reasons. We know the carry is persistent in the forward market and the interest rate differentials. And we don't really know what the currency is going to do over the short term. So the balance of those different components, I think, really advocates for strategic currency investing, currency hedging, but also in the current environment, currency hedging to get that carry that currently exists. Yep. So this is just a simple snapshot across the different regions. If you look at the 5-year backward-looking volatilities between the hedged and unhedged markets, you can see the differential here is anywhere between 2 and 3%. So when you add the currency in, i.e., you chose not to hedge the currency risk, you are adding 2 to 3 points of volatility. And when you think about it, proportionate to the amount of risk that you have in the underlying equity market, you're adding about 15 to 20% additional risk. And so obviously this gets a little bit complicated, but when you think about the ability to generate comparable returns, and this is not even accounting for the currency carry that we'll get into, but comparable returns with 15 to 20% less risk, that to me is capital efficiency. That to me is the ability to take risk in other parts of your portfolio that you can be compensated for. So in my mind, it's when you compare 2 bars where one is demonstrably riskier than the other, but it doesn't really get you anything over the long term. It doesn't really make sense to invest in that orange bar that's more risky. Yeah, so here we just simply show the empirical volatility. And for the sake of simplicity, although this is going to be similar across most markets, Japan is the one exception. We can maybe get into that later on. It's a nuance market. But when you look at EFA, so representative of the, let's say, developed markets ex-US, you can see that over rolling periods of time, that unhedged index, the one where you assume currency risk, is almost always more risky than the one where you hedge that risk away. And the right-hand chart is simply the differential plotted by itself. But you can see the average of that differential is roughly about 2%, as I mentioned before. So long-term, over most periods of time, hedging the currency risk reduces your volatility, and on average, it reduces about 2%.
Yeah, I think this is really fascinating. Jason, you make a really good point about the volatility reduction. And you mentioned this earlier on, and I just want to make sure that, well, I'm clear and that the audience is clear too. Again, why does adding currency risk not improve diversification in the portfolio?
Yeah, and I think the key word that you mentioned there is just adding the risk. Usually, when you think about risks in a portfolio, you usually take $1 away from something and put it into something else. In the case of currencies, Think about it very simply. When you buy, let's say, Volkswagen stock, I trade my $100 for, let's assume it's 1-to-1 for simplicity's sake. You trade your $100 for 100 euros. So now you're long euros. Then you trade your 100 euros for, I don't know, 2 shares of Volkswagen stock. So by consequence of doing this, and this is how you invest internationally, you own 100% notional risk of the currency and 100% notional risk of the local equity market. And so when you have basically 200% risk, that hurdle or that threshold for diversification of one asset versus the other just becomes extraordinarily difficult and basically almost unachievable over time. And so on the left-hand chart here, we show the 2 component risks. So again, it's the currency basket, and it's the local equity. And on the right-hand side, we show the correlation between the two, the interaction between the 2 component risks you own when you own unhedged international investments. In this case, we're talking about ETH equity, but this applies to any international investment. What we've shown here, and we actually have a really nice paper on this as well, but we show here, because you have that leverage, because you have 200% risk, the point at which the correlation has to be sufficiently negative for the currency to diversify risk and reduce the risk of the portfolio is actually quite negative. That blue line on the right-hand side represents that sort of break even, the point at which when the orange line is below, the currency does actually reduce risk. And you can see here in the chart, on average, that has to be about negative 0.3 correlation. And in actuality, when you think about the fact that I mentioned to start that the dollar is a safe haven, typically when stocks go up, the euro also goes up. And when stocks go down, the euro also goes down. So in general, and particularly this year is a really good example of it, when markets sell off, that correlation will spike. And that differential in the risk, when you assume that currency risk, is going to be much more dramatic. And by consequence, the drawdowns you experience in adverse market conditions can be much more dramatic if you own the currency risk versus if you choose to hedge it, you basically eliminate that risk that you didn't have to take to begin with. Yeah, and this, again, I think I've heard the phrase used before that you can't eat volatility, which I don't necessarily completely agree with that, but I think the way to kind of demonstrate volatility in ways that make more intuitive sense is to show that volatilities and drawdowns are directly related to one another. So over this time frame, the maximum drawdown of the unhedged ETH market has been worse than the hedged ETH market in 16 of the 21 calendar years. In this year in particular, the hedged market was down 14.5%. The unhedged market, where you assume that currency risk, was down 28.5%, so nearly double. Obviously, this is kind of an outsized move, and this is, one that I would not say is typical. But that kind of speaks to the fact that, one, by assuming more volatility, you are susceptible to bigger drawdowns. And two, when you are uncertain of market conditions, the dollar is actually a really good diversifier. And therefore, being short the dollar, if you're uncertain of the market going forward, which I think there are a lot of question marks in the current market or macro environment, it's taking on the currency risk is not always advisable, I would say.
That's great. Let's do a little bit of a transition here and make this a little more, if I can call it, tangible for the audience. So you've talked about the volatility reduction, the lower max drawdowns. To me, this is really powerful. I think most investors, though, are starting with an unhedged position. So they might own an EFI ETF that's unhedged, that's more or less the standard starting position. So if they want to start to incorporate currency hedging in the portfolio, but they're maybe not ready to just switch entirely to currency hedging. Is there sort of a maybe a middle ground, maybe a way to look at blending the two strategies?
Yeah, there definitely is. And we actually, do you mind scrolling forward to the next slide? Yeah, so I would say that, I would advocate for 100% hedge, but as you mentioned, I think in a lot of cases, investors have to be, they don't necessarily want to be offsides versus their benchmarks or versus their peer universe. And so I think those considerations are perfectly valid. What's interesting is the volatility reduction you get from hedging part of your international allocation is actually not a straight line. Because when the interaction of the two components, there's a interaction component to their portfolio risk equation. But the consequence of that is basically when you hedge up to 50%, you are getting more volatility reduction than the amount that you're hedging. And so very simply, if you hedge about half of your international equity exposure, you're reducing the risk by about 2/3. So I think for people who are not, for whatever reason, don't want to hedge the entire allocation right away, hedging 50% of that allocation does get you about 2/3 of the volatility reduction, which is a really nice in between. But again, I would just fall back on the fact that I would say, personally, I think there's a strong case for 100%, but this is pretty compelling if 100% is kind of not what people want to do at the moment.
That's great. So there's a practical argument for keeping perhaps half of the allocation in an unhedged ETF or other vehicle and half the allocation in a hedged ETF or other vehicle. Another pivot here now, Jason, let's layer on now the impact of interest rate differentials and this topic of carry.
Yeah, of course. So carry, I would say just the high level is basically monetizing the differential in interest rates between regions. So I'm going to use the Europe example just for a single pair, but US interest rates are higher than European interest rates. When you hedge, you basically buy dollars against euros. What you're effectively doing is lending somebody dollars and borrowing euros from them. You lend them dollars at a higher interest rate and you borrow euros from them at a lower interest rate. And by consequence, you are earning more interest than you're paying, and therefore you're able to generate currency carry. Functionally, we do this via the FX forward market, but the FX forward market is priced based on these interest rate differentials. If it wasn't, then somebody would arbitrage and make the market go back to that normal environment. What that means, though, because the dollar rates are so much higher than international rates, the euro I mentioned, but the yen as well, the difference between US and Japanese interest rates is even more dramatic than US versus Europe. But when you aggregate all of that and you look at the discount of the forward that we're using to hedge versus the spot rate, i.e. the currency carry in this case, you are generating 2 to 2.5% carry per annum. If you look at the 1 month annualized figure. What I've done here as well, and the convention for a lot of these is to hedge 1 month forward, just because you want to maintain the right hedging ratio. But I also looked at it over the next 1, 2, and 3 years, because when you step into something, into a market, you want to understand whether or not that carry is persistent over time. And if you look at 1, 2, and 3 year windows, because interest rates are expected or priced into the market to be different between regions, the US rates are priced to be higher than other regions for at least the next 3 years. Carry is something that will benefit people who hedge their currency risk for that 3 year window at least. You can look at this farther out as well, but I think the stability or persistence of the ability to generate carry by hedging your currency risk is something that is quite compelling. And again, I think baseline, the volatility is something that we feel like happens almost always. Currency carry is something that we think happens sometimes, but that sometimes right now is going to be the case for at least the next few years.
So how much conviction do you have in that? Because we don't have conviction in the direction of currencies, but how much conviction do you have in the interaction between the interest rates between regions?
Yeah, so again, as I mentioned, it's not a matter of forecasting in this case. It's a matter of the market pricing. The market pricing for the forward 3 years out implies, and you can do this as well, is a 2% difference per annum in the rates. The confidence I have in terms of the interest rates, I don't know where US and European interest rates will be in 3 years' time, but I don't think there is almost any probability that European rates are going to be higher than US rates in 3 years' time. So even though, because we use 1 month, again, to make sure that you're hedging the right amount, because the underlying values can change of the equities, it's still, I still think there's a very, very high likelihood that currency carry is persistent for the foreseeable future.
Great. Let's do one last concept before we transition to questions with Alicia and IVL. Show us what this looks like in a portfolio if we had a diversified portfolio.
Yeah. So this is actually just a simple comparison of the hedged and unhedged international exposures. Again, what I would mention is, so the returns, I think probably everyone at this point knows that hedging your currency risk has helped your performance, your returns quite significantly given the dollar strength. But I wouldn't really necessarily fixate on that part of the page, just because, again, we cannot necessarily predict with a high degree of confidence what the dollar is going to do over the next couple of years. I think the point that we fall back on, again, is the fact that when you choose to hedge the currency, well, I mean, the way really to think about it is when you decide not to take on risks that you don't necessarily want. But when you hedge the currency, you are reducing that volatility by about 1.5% to 2%, depending on the time frame, and you're reducing the amount of drawdown you experience when the market goes south. I think those are the main points, and then I would just sprinkle on the carry component as well. Those returns are driven by both the spot return, but also the carry. The carry is incrementally something that should be considered. Let's say even if you think there's some chance of dollar weakness, the currency carry can help to offset that as well. So the focal point, I think, of this particular exhibit should be the risk, but the carry should be a consideration in returns going forward.
Yeah, Jason, thank you so much. I mean, throughout this content, you've done an excellent job. You've flipped this topic for me on its head. I think a lot of people think about choosing to hedge as being a decision, but what you're actually saying is choosing to remain unhedged is a decision to add volatility to the portfolio, whereas the actual starting point should be to be hedged, which would cause the best reduction in volatility. I think that's a really great takeaway from my perspective. If you want to add a remark to that, that's great. Or IBL or Alicia, if you want to move on to questions.
So Dean, I actually, and this is something that has come up from time to time as well, is what's interesting is when people invest in fixed income in the global ag, for instance, they always hedge, always. It's the same math, whether it's an equity allocation or a fixed income allocation. The reason people always give for hedging the currency risk in fixed income is, the currency is too risky. And while if you look at the proportion of volatility between the currency and the fixed income, the ratio is different than it is in equities versus currencies. But two things, one being the math is the same, and two being when you have a total portfolio of stocks and bonds, the portfolio doesn't care if the currency risk comes from the equity or the fixed income. So to me, it's always kind of an inconsistency to say, well, in this particular market, I'm unwilling to take currency risk because you don't get anything for it and it adds volatility. But in the other part of your portfolio, the equity part, that argument no longer holds true. I just don't really understand that line of reasoning.
That's great. Alicia, did we
Indeed,
get any
thank
questions?
you. Yeah, thank you very much. I just want to remind our audience that you can post your questions through the chat. In the meanwhile, we would like to ask IVL to, I know you have a couple of questions. If you can please start with your questions, and we will follow up with the audience questions later.
Thank you, Alicia. Sure thing. I think Jason answered a few of these. Let me go to the relevant one, since you mentioned that you have managed portfolios previously, Jason. And the question is, what are your thoughts on active managers incorporating various degrees of currency rate hedging into their strategies?
Yeah, so I would tie this back to the comment that I think Dean just made, which is, if the manager is really good at currency investing, then by all means do it. But the starting point should not be to take on that currency risk. Their sort of neutral position. Think, if I did not have a view on the euro, why would I buy euros? You know, so I think this is not so much an answer on the active piece, because that really depends on just how good the manager is. But in my mind, their starting point, without the view, and I think most currency funds, for instance, would feel this way as well, is you want to be thoughtful about the fact that you don't want to take risks on unless you have those strong views. Understood.
And the other two, I think the other one you already answered, but the other two is around currency hedging. There's this belief that it's too complicated and expensive. Is that true or no longer true? What are your thoughts in there?
No, it's no longer true. Again, the carry, I think, maybe should not be thought of as an expense in the operational sense of the word, but the carry definitely benefits people who choose to hedge their currency risk at the moment. But from a market access standpoint, and I think this is a really important thing as well, is hedging the currencies in international equities in general. Doing it yourself can be quite challenging. You know, you have something, I forget the exact number, but something like 15 currencies, and you have to trade all of those forward markets. But given the fact that there have been brought to market in scale a lot of solutions that provide quick, easy access to currency hedging, and again, this is using 1 month forwards for the MSCI methodology, and they're priced, I think, quite well. I shouldn't get into that exactly, but the pricing or the access to these investments, I think, is kind of game changing in the sense that perhaps if I presented this, I don't know, 10 years ago, people would say, well, I can't do it myself. But nowadays, you don't really need to do it yourself. You kind of have the toolkits in the ETF market that give you easy access to things that make a lot of sense in given the math.
Understood. Good points. Alicia, any questions from your side that have come in?
Yes, we have a couple of questions regarding Latin American currencies, and if it is more expensive to hedge a portfolio from emerging markets in general, but particularly when we're talking about Latin American equities.
Yes, and this is a good point. Again, the framework is meant to be objective in the way that it evaluates the different components. So if you don't mind scrolling back, and I'm blanking on which slide exactly it was. Actually, give me one moment. It is slide 9. But in general, if you look at different periods of time, hedging the, let's say, LATAM or more broadly emerging markets, the risk reduction that you get in volatility terms is a bit higher than it is for developed markets. The carry, though, this is a really astute question, is because the yields in Latin American countries or in Asian emerging markets can be higher than the dollar. That carry case, for instance, that I mentioned, isn't always going to be to the benefit of hedging. So I think in the current environment, there is about a 1% negative carry. So I think when people are thinking about this, they should be thoughtful of the fact that the carry does not, the difference between developed market currency carry and emerging market currency carry, there is a nuance there. It's not necessarily going to make sense all the time. But in terms of the risk reduction, that is the same case. And in fact, it is a stronger case. Emerging market currencies, they tend to be even more correlated to equity markets than does the euro, for instance. And so the drawdowns, I don't have that exhibit on that chart, on that page, but the drawdowns from hedging the currency back to dollars, that actually typically is more significantly different, as in the drawdowns for unhedged tend to be even worse. But again, as the question mentioned, the currency carry may not benefit you. It might actually cost you a little bit to hedge EMFX or EM-LATAM-FX.
And Alicia, we have this topic well covered in our research available on our website and in a paper that we have. So if anybody's interested in that, please reach out to me or IBL.
Perfect. Then you also mentioned that investors typically hedge their positions in fixed income, but they don't hedge them in equity. So we have a question regarding types of portfolios like defensive, balanced, or aggressive portfolios. And they're asking in which portfolios does it make more sense to hedge or not to hedge?
Yeah, so this is a bit of a philosophical question. I'm of the view that if an investment makes sense, if it's a good investment, it should be part of almost every portfolio. You just size it appropriately. So let's say an equity that has a really good return risk profile, if it is risky, then you simply just own less of it. So I would say, and this is a risk reduction argument as well for currency hedging, is currency hedging belongs in all of those portfolios that invest in international equities. Now, if you think about it in absolute terms, the relative, let's say, volatility or potential for drawdown, perhaps you can make an argument that it's more of a conservative approach to investing internationally. But again, you're not sacrificing any expected return. In actuality, you're able to generate about 2.5% additional currency carry. So, the answer that I would give is it should be in all of those portfolios. But if you think about the volatility, then maybe it's like it can be viewed as a slightly more defensive version of international investing.
Sure, thank you. And then we have a very direct question. Would you say that the time frame to hedge is a 3-year portfolio? I mean, or if it's longer term than 3 years, it doesn't make sense to hedge the currency.
So I would say that it's a long-term thing. The case that we make is because of that volatility differential, you should, unless you have a very strong view that the dollar is going to weaken, your starting point should be not to take on the currency risk. Your starting point should be to hedge the currency and eliminate the possibility that the currencies that you may or may not want to own will fluctuate in value. The 3-year, I think, is when you start to think about the currency carry, which again is not the fundamental argument here. It's simply the current market environment. So in terms of risk, I think it makes sense to always hedge. In terms of carry, I think it makes more sense to hedge today than it did a year and a half ago because the carry exists in the current market environment and will persist for at least the next 3 years. So it's stronger argument today because of the carry, but the argument in risk is always true.
You just mentioned the current market environment. So I don't know if you want to go into this, but we do have some questions about what are your mid to long-term views on the dollar against the euro and also against Latin American currencies. I just have to ask because we have some questions about this.
Yeah, of course. And obviously, as I mentioned before, the past year, for instance, there's been a lot of capitulation in views. You know, if you remember a year back, everyone thought the dollar was going to decline in value, and everyone was wrong. And that doesn't necessarily mean that people are right or wrong. I've heard the saying that it's just as impressive to be wrong all the time that it is to be right all the time. Over the next year, though, I think what you've seen is a lot of the positioning kind of pivot away from very strong directional currency views. Our dollar, euro, and dollar yen forecasts are actually relatively close to the current spot rates, which you kind of have like a balanced reasons why the dollar might appreciate, being the carry, being the defensive nature, reasons the dollar might depreciate, which is some of the valuation metrics, positioning. But the net of it is really kind of a mixed bag. And again, when I think about it, and sorry, this is not precisely the answer to your question, but when I think about having uncertainty, investing in something that I'm not sure what it'll do, I don't see a strong reason to invest in it. And in this case, it being owning the currency risk within your international equities.
Indeed, thank you very much. I don't know, Dean or Aviel, if you want to add something into this.
No, not from my end. I just want to thank you and the whole Fund Society team for making this happen. Dean, Jason, any final remarks before we wrap it up?
Nothing here. Thanks so much, everybody. We really appreciate it.
All right. Well, thank you very much. Thank you for joining us once again. Thank you to DWS and to all of you who have joined us this morning. And just I want to let you know that the presentation has been recorded and it will be sent to you, to all of you who have registered, so you can see it again whenever you want. Thank you very much.